This is a download from BFM 89.9, the business station.
Good morning, Dodge. So, U.S. jobs and employment rate held at 6.7% as 192,000 jobs were added in March. Was this in line, actually, with your expectations?
Good morning, Nadia. Well, actually, overall, it was better than what I expected. Not because it was outstanding, but it indicates a return to slow and steady job growth after a period of some volatility. It also verifies a continuation of the job gains over the pace of labor force growth. So this is longer term quite positive. The lower than expected addition of 192,000 jobs, it actually masks some of the promising details behind the figures. For example, January and February payrolls were revised up by a total of 37,000. So that minimalized that slump that the market was reacting to before. Also, private payrolls hit 116 million and edged over the pre-recession peak by 110,000. Yes, we realize that total non-farm jobs are still 437,000 below the prior highs. But again, this is good news. While the jobless rate held at 6.7, that actually was good news because it was primarily due to 503,000 joining or rejoining the workforce. Yes, labor force participation is still low by historical standards, but it is improving. It got jumped up from 62 to 63.2%, and this is the highest level we've seen since last September. The average work week rose by 1.1%. That was the biggest climb in 18 years to 33.7 hours. Yes, it was also offset by the average hourly earnings declining. So, as you can see, nothing is screaming bullish. Yes, we still need to return to above 200,000 job growth on a monthly basis. But the upward revisions over the past 2 months are important, and the movement of people back into the labor force is a particularly encouraging sign.
Do you think that this will be maintained, however, that this slow and steady growth over the next couple of months?
Good question. It remains to be seen. The proof is going to have to occur. You cannot expect it. But given the attendant circumstance that we've just come through, January and February, it is more likely than not to continue on a slow basis. And as long as it's slow and it doesn't create an upward, more of an escalating upward revision, it will help the Fed to maintain its course and not to accelerate the tapering. So, at this rate, Nadia, it's a good rate. It's slow, but it is positive. And it is more likely to continue over the next 3 months. But you are right. The next 3 months, as we get into the summer season, will be extremely important to watch.
Do you think this will have an impact on the market, given how already buoyant it is as of late? Or will it just be seen as another positive catalyst that will help to underpin sentiment?
Well, we had a real pullback on Friday, and I think it's going to be more of a sentiment thing than a support of a move to the upside. You look at the S&P, it did break out to a new all-time high earlier last week. The breakout was confirmed by a new high in the S&P 500 advanced declining line in terms of stocks. So that suggests a longer-term healthy market. The primary trend will continue to be healthy. But given the sluggish action we've been seeing in terms of buying power, in other words, if you take a look at the stocks that are going up and you look at the volume on the buy side versus the volume on the sell side, there's still quite a risk for short-term correction, and we expect that to remain elevated for the next 3 weeks. I mean, our bull market is pretty long in the tooth at this point. So the fact that we're having some good economic news will help us bridge the transition of market valuations from the low interest rates which we've been having back to more fundamental economic analysis. But that remains to be seen. So I suspect this is just part of the continuing transition that we're experiencing and nothing more.
Ukraine is now seeking gas imports from its EU neighbors following a hike from Russia as its economy weakens. Do you think there is a chance of contagion risk?
Yes, I do, Nadia, and I really do believe it, and we've got to be watching this now, because reducing Europe's dependence on Russian gas, it's possible, but it's going to take time, money, and sustained political will, and that remains to be seen. We really have to watch in two areas. First is the very direct area of the supply of oil and gas. if Ukraine continues not to pay its bills, and it can't without outside help, it's possible that they will be cut off. Now, if Gazprom reduces the flow of gas to reflect the fact that Ukraine no longer is paying and has a right to it, then it takes some of the gas, and it takes some of the gas away from Europe, then the Ukraine no longer has a right to the gas, and it's going to start to cut into what Europe is getting through this line. Obviously, Europe is getting 24% of its gas from Russia now, and over half of that is coming through the Ukraine. So this is going to be particularly important. And if you recall back in January of 2009, for 2 weeks there was a cutoff, and we can see the impact that had. It was short term, but it does remain as a real issue for now. On a more broader basis, away from the direct impact of oil, you have to take a look at the financial markets. And this is really where perhaps Europe and the United States have a little bit more power in the process here. To sell its oil easily, Russia needs access to the world financial system. Its companies need to borrow in the bond market. They want the shares to be traded on international exchanges. They also need to process payments in dollars. Because the U.S. dollar is right now the international currency that's used for energy transactions. So this gives Europe and America a considerable leverage if they choose to exert it. Russia's biggest oil company would be badly damaged if it were to be delisted on the London and New York Stock exchanges. Financial sanctions could also make it hard for Russia to sell its oil to third parties. So this is away from the actual delivery of oil. So yes, there is a risk of escalation, or at least expansion of the risk beyond just the delivery of oil, and that's what we're going to have to watch.
Emerging market currencies showed some rally against the dollar, but do you think this is temporary?
Temporary, yes, it has had a rally, and temporary in terms, I do expect this to continue for the next 6 weeks. Now, we're getting into summer, so I expect through April and May, I do expect a continuation of interest in, and if you take a look at the MSCI Emerging Markets Index, that's a widely followed benchmark, we expect it to continue. It's now in positive territory for the first time this year. We expect to see that in positive territory, perhaps a slight increase of maybe 3 to 5% between now and the end of next month, the end of May. And then once you get into summer, from June through the end of September, we expect it probably will not have a continued acceleration, but I do not expect it to return to the prior levels. I expect the rally that we've seen to hold for a while. Perhaps there'll be a slight return to prior levels, maybe a reduction of 2 to 3%, but we do not expect to have a return to the lower levels. We expect to see this continue through the end of summer.
That was Dodger Dolan, Chairman and Chief Investment Officer of Landa Infused Capital Managers in New York.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.